Welcome to the PROACTIS Group Full Year 2020 Results webinar. I now hand over to Tim Sykes, CEO, and Richard Hughes, CFO.
Thanks, Tamsin, and good afternoon, everyone. Thank you for taking the time to listen to this webinar. So I think the key messages that we want to get over for the 12 months that we've been through to 31 July 2020 are that we're progressing reasonably well against our strategy. We've started to deliver the return to growth within the group with a record year in new business performance and significantly reduced churn, which has allowed us to report for the first time in 3 years now a return to organic growth in our underlying ARR. That's a crucial, and both of those issues are really crucial elements of our story and our recovery program. Obviously, more detail in the presentation in further slides. I think also what's important is that we have shown that PROACTIS is very robust with a resilient business model through what has been for everyone a relatively challenging environment, of course. So we've had a smooth transition of our teams with little or no disruption for customer service, and adverse revenue impacts have been largely offset by natural cost savings, which has allowed us to report our pre-COVID earnings performance through this period without any adjustment. And all of the work that's been done over the last 12 months by all of our teams has put us in a really good position to be able to continue to accelerate our growth from what we've seen in the last 12 months. And again, even though we don't expect that to go quite as quickly as it would have done pre-COVID, we're maintaining earnings guidance for FY21 at the pre-COVID levels. So I think we have some super opportunities ahead for the group, and hopefully you'll get a flavour of that as I take you through the presentation. So if we look at the more specificity about our highlights for the period, against the strategy of deploying a single product internationally, obviously key strategic business wins are important where we sell that product for the first time in each of 3 territories. So we have sold our single business platform solution into Germany and into France now. So a very important proof of concept, you might say, at one level. And also pipeline in behind those first early adopters is strong. So we're confident about our ability to win new business going forward with this single business management platform into each of those 3 territories, and therefore replicating the performance, hopefully in due course, in all of those 3 territories that we enjoy in the UK and the Netherlands, and more of that later on in the press, of course. We have identified early adopters for the bePayd platform in both the UK and in France. Clearly, I've been saying that for a while now, and I do appreciate that, but we are very close to a contract there and look forward to deploying it and hopefully accessing the opportunity that we have for that extra revenue opportunity as we go forward. Again, there's a slide further on in more detail, but happy enough with that progress. Of course, it's an innovative product sold to conservative buyers in a difficult market, so it's difficult to get things moving quickly in these times. Crucial to our story and fundamental concerns for investors 12 months ago was a banking relationship, and we've obviously reset our banking facility with covenants and all of the sort of appropriate governance around that facility now aligned with the current business plan, and therefore we feel that we're now fully funded and for the midterm. Obviously net debt is relatively high for a public company, but it's well structured and the covenants and the regulations around it are set for the current business plan, and we're very comfortable with those levels. In terms of our commercial progress, well, the standout performance or the standout highlight is the new business progress. 30% increase to almost 15 million from around 11 million last time. There's a lot more opportunity for that, and we'll show you that in due course. We would say that COVID is impacting, obviously, new business, and we signed 7.5 in the first 6 months and 7 in the second. We would have looked for progression generally in the second half from where we were in the first half, but that has been difficult with COVID. It is slowing down decision-making processes. Crucial to the story is our net growth in ARR, excluding the heightened risk accounts that we highlighted a couple of years ago now about the difficulty that we have in certain product areas, but a return to growth, and that's a really seminal change. And underpinning that is 8% in our non-volume related ARR and 12% reduction in our volume related ARR as a result of COVID-19. So the underlying story is even stronger, actually, in terms of what we've been able to achieve. We have done well in our heightened risk accounts in that we've changed a number of them into multi-year deals, and therefore they've come out of that bracket of being heightened risk and moved into business as usual, as we'd all hope. And overall churn has reduced by some 40%. So we feel that we are really going in the right direction now, and lots more opportunity to go and access. In terms of our financial highlights, I think everything has been in line with pre-COVID plans. I've mentioned the net debt position, which is relatively high for a public company, but structured well and in control. And then we have had to take an impairment as a result of the management structure and the cash generating units that we now run, rather than ones that were previously run. And Richard will talk a lot more about that during the course of his report. Post-period end, we have had the retirement of one of our executives, Sean McDonough. It was always Sean's plan in his career pathway for this to be his last year. So he's on his notice period, and we wish him really well and thank him for all of the service that he's provided over the years towards us. And then Sophie Tompkins, a sort of the regulatory non-executive, independent non-exec, has resigned to concentrate on her other portfolio items. A little bit more detail then about the current impact of COVID. Operationally, very robust and resilient, no disruption to customer service levels. Our teams are working from home or in the office, depending on which specific guidance there is. The teams are well connected, well engaged, and are set up to continue ultimately indefinitely if that's required. All of our tools that we use in terms of our management processes are online in the cloud. So well set up for exactly this eventuality. How has COVID-19 impacted us in terms of financial and performance terms? Well, the revenue impacts have largely been offset by a slight reduction in related churn and natural cost reductions, things like travel expense, that kind of area. But in particular, there are deferrals of buying decisions, lengthening sales cycles. That does slow down TCV and new business attainment, which is a challenge for us, which we're meeting as much as we possibly can. The deferrals of implementation projects and that deferring services revenues as customers are unable to pull together logistically the capability of their teams to run projects. There has been an increase in churn in Tenders Direct product, which has resulted in revenue loss. But we have really returned that business to net growth post-period end, which is a super step forward for that business. Where we've been principally hit on revenues, and there's again a slide I can show you later, which will quantify it for you, is in our service-related business where we have volume-related ARR. So these are long-term contracts where we deliver an outsourced service. And those are in our outsourced tail spend area in the United States, our reverse auctions business in the States, and some invoice processing in the UK is just hampering that kind of volume-related issues and the progress that we would naturally have seen. So these are not where customers have left us, so it's not churn in that sense. It's just purely volume-related services that have reduced over this period. So to reminder of our strategy, well, this should be a reminder, hopefully, for most people on the webinar, that it's 5-pronged. The first 2 related are specific to our business spend management solutions business internationally. So the first thing, of course, is to maximize the existing value of our customers and our technology, with an ultimate objective of any kind of churn being matched by cross-sell, upsell. And therefore, we're never essentially stepping backwards year on year, never have to win business in order to stand still. And that is about there now. We've seen the reducing churn come through. When the heightened risk accounts fall away, we'll absolutely be at that point. So we're very well on our way to that and on track and delivering that first core foundation of the strategy that allows us then to move into the second area, which is our new business performance, which should be driving our growth. And our ultimate target here is to deliver £8 to £10 million of net new ARR per year through new business. And I think I can show you in a later slide how that comes through. But so a very aggressive target in the long term, or a potential opportunity for us. We are being, as I say, hampered in the very short term through COVID-19 just impacting the rate that we can accelerate. But the potential is still there for us to go and achieve that kind of step forward in the performance of the group. We also, of course, are now at market with bePayd, and the potential there is significant, we think. Our target here is to have 50 buyers signed up in the next 3 years. It can't just happen tomorrow, unfortunately. We wish it could, of course, but that's not possible. But we think the solution is compelling for buyers and for their suppliers. The value is good. And we are excited about our opportunity to realise that potential. Again, the scenario that we're living in right now with COVID makes that more difficult to sell, but it is happening, just going slightly more slowly than we wanted to do. And then we move forward into some other supplier paid products. So I talked about our tenders direct business, and I've talked historically about our transactions business, where suppliers are paying to send their documents, their purchase orders, or send their purchase invoices, or receive their orders electronically. That's a key theme for financial year 21, this financial year, where we're looking to change the outcomes that we've been achieving there and improve them. And then further and further out and in time into FY22 and beyond, we want to extend that supplier paid product portfolio, because as we see networking start to come through into the customer base, that opens up opportunities for us to provide a great buyer-based theme, but that a supplier is prepared to pay for, aka an a la bePayd. The next slide is just to give an indication, really, of where we operate and where our target market is, and this is crucial, of course, to our definition of the strategy that we've set last April. And it gives us a differentiator with our other global players in the space. So the other global players that we're talking to are ever increasingly headed towards tier 1 and global operators. And then we have SMEs operating in the very, very lower end of the market. We are a targeted business aiming at that mid-market space. It has its own special USPs around value and around speed and access and time to access the benefits of the product, as well as all of the other feature functions and control aspects that are required to deliver into that space. So it's a pure market. We are the single international player that plays in that particular space, and we're very targeted towards the special needs of that segment of the market. And then how does this occur and what drives demand? Well, there are strategic needs for the requirement. Could be an ERP system deficiency, or a commitment to digitalize and reduce paper and grit out of the machine to get efficiencies through that. There could be a corporate governance failure through a lack of control over a spending decision, for example. Or it might be about personnel change. We quite often get introduced to new companies when there is transition in the vertical, so to speak, where people move from, a CFO moves from one company to another and deploys PROACTIS in the new business that they've moved to. We operate in certain verticals that are largely around the services area, and that's because there's a high degree of indirect spend to total spend in those verticals, and that's where we sit very, very nicely. And we have good proven capability in those areas and referenceable in those verticals. And then the go-to-market process, we sell directly, largely. That's what our kind of customer wants. They don't want to see intermediaries particularly. We have introductions, and we're networked into the mid-tier consultancies and or specialist consultancies on a sort of an introductory relationship basis. And some, very few, and only really in the UK, where we go to market indirectly through value-added resellers. And so a separate slide, particularly around bePayd now, which is, well, let's just remind ourselves what bePayd is. So it's a platform that allows suppliers to get paid earlier than they ordinarily would through their existing terms. So if they're terms of a 60-day terms with their customer, but they need the money early for whatever reason, or they just want control over collection of their money, then they can accelerate that payment as long as the invoice is approved for the payment of a small discount by them. And we're talking here as a model of around 2% for a 30-day discount. We're targeted at the very SME end of a supply chain of a customer, so that we call that often the tail spend. And there's a vast number of small suppliers that are traditionally underserved. There is limited risk on the product, however, because it's around buyer solvency and or late payment. So we don't take any risk on the suppliers themselves, even though they're taking the advance of the money. So it's not a lending product, it's an asset purchase agreement. So in terms of the progress we've made, well, the product is live. It is a market-leading product for what it does in terms of its speed and its flexibility and its convenience in terms of a supplier being able to get their money quickly without any detriment to risk or security. Deployable as a buyer-funded model, so the buyer can take the software, run the software itself, and fund all of the early payments if they wish, or PROACTIS can step in and do that funding through its back-to-back facility with HSBC, or there could indeed be a blended model. So it's entirely flexible as to how a buyer wants to enable this service to apply into its supply chain. We have early adopters that are contracting with us, so not contracted. It's not past tense at this stage. We're hopeful to move forward quickly to that status where we can say that we have final contracts, but we're contracting and planning for implementations. One of those, interestingly, is a PROACTIS funded model, and two are buyer funded models. So a flexible approach and a nice breadth and a nice range of opportunity for us in the early adoption phase. Ultimately, then, we need to look at and need to learn once those contracts are signed with the buyer as to how they want to deploy that program into their supply chain, and that's where we'll understand about revenue take up and how that might progress over time. So we don't have an awful lot of revenue in our forecasts for this because there's so much still to learn. And then how is COVID-19 affecting it? Well, I think initially people would say that the offering is highly relevant, of course, in this environment because people are looking for cash, are looking to accelerate cash or be in control of receipts and funding cycles and cash flow. And this product helps all of that happen for those smaller businesses. However, it is an innovative product with multi-layered decision processes around finance directors in organizations, around procurement people, and around IT people inside of those organizations. So it's an innovative product into a conservative customer base with difficult decision-making processes made more difficult by COVID, with competing priorities, of course, and that is slowing the progress from where we thought it would be at this time. But no less interest or excitement from the company around the potential opportunity for us in size and scale. So if we go now into a little bit more detail on the commercial updates, and these are the slides with the detail that I referred to earlier. So first of all, let's look at our TCV performance across the group, and as I say, an underlying principle of a record year of 14.6 million, up 30% against a relatively weak 2019, I would say. Our hypothesis here is that we believe there are no fundamental reasons why the French, German, and the United States markets should not behave equivalently to the UK market. And our belief state comes there is because our software is capable of solving the same business process issues for a finance director in the United Kingdom and the Netherlands, as well as it is in France, Germany, and the US. There's no intrinsic difference in the business process that our software supports. And I think that the hypothesis is solid. We then look at performance in the UK and performance in the Netherlands. And if we look at the UK, we look at 6.5 million as a average sort of performance of TCV over the last 2 years. But what that doesn't cover is a pipeline issue that we inflicted upon ourselves as a result of the Perfect Commerce acquisition, which led to a hole in our pipeline during the second half of 2019 and the first half of 2020. If we look at 2020, there was a 2 million TCV in the first half and 4.6 in the second half. So we believe that a fair run rate of performance in the UK is a range of around 8 to 10 million per year in the United Kingdom. That's based on the last 6 months' performance and the 6 months in the first half of 2019. So if we believe in that, and therefore we believe that France, Germany, and the United States offers us equivalent opportunities with that single spend management solution, that platform that we have, then there's no reason to expect that in the fullness of time, as we grow the capability, the capacity of the marketing and the sales teams, as we deliver referenceability and all of the things that are required in order to deliver that kind of performance in the UK, as we replicate that over time, then performance and outcomes should be similar or the same. And of course, if we do that, then then we can easily see the opportunity here, and that's to grow TCV up to somewhere between 35 and 45 million per year. And of course, that as a proxy for ARR might deliver easily 8 to 10 of ARR per year. So that's the prize that we are aiming for, having aligned the strategy around a single market segment, a single solution into that market segment, and then equating and making equivalent the business processes that enable that to happen. All of this takes time, of course, because it's not easy. And we have to find the right people over time to be able to deliver it. We have excellent capability in all of France, Germany, and the US now for this phase of where we're at in the strategy, but hopefully we can build that quickly as and when COVID starts to release us and we start to get referenceability. And that's why it's been important for us to announce things like the US SAP deal last week in France, which was the first sale in France of that new business platform. And that supports the Dividag, as we call it, in Germany earlier on in the year, and hopefully shortly, decisions around specific opportunities in the States. We'll then move on forward into further early adopters, move into implementation and referenceability, and then really push hard on the volumes as we start to go through those processes. So huge opportunity for us, great pipeline in all of the territories to support where we're at today and to drive performance with that prize in mind in the mid to long term. If we look at ARR, which is the core value, you might say, for certainly financial value of our business, I want to highlight here a couple of issues that have been impacting our business. So first of all, the HRA accounts. So you can see we brought those below the line. That's because at the end of 2019, we felt it was necessary, given the issues that the group were facing and the fears in the investor base around what was happening inside of PROACTIS after two horrific years from our perspective, and we would say entirely abnormal years, but that which accrued to us following our acquisition of Perfect Commerce. But we have churned through HRA accounts this year, and some interesting developments in those, which I can describe on a later slide, but that's clearly impacted adversely total ARR. But underlying that, we have actually grown ARR. So some of the HRA accounts have, and I've described it up in the bullet point to be completely transparent and open, we have actually won or re-won some of those accounts. So where they've gone out to RFP and gone out to tender, we have actually been able to win some of those customers back on new PROACTIS products rather than the non-PROACTIS products that they were running on before. So very, very happy to have done that. But even without that HRA account conversion, we have been seeing positive growth in non-volume related contracts. And then in the volume related contracts, those that I described earlier, the business services, outsourced tail spend, reverse auctions, invoice processing, we've seen a 12% drop, and that is COVID related. Essentially, so very little churn in those areas, and it's largely COVID related. That has influenced it. So you can see there a very attractive 8% growth in non-volume related contracts, the core of our business, and growth still, even if we stripped out the conversions of the HRAs. So very happy at this stage with that ARR performance. But as you put it in, that's in the context of the previous slide and the opportunity that we have to go and execute. And if we look on the detail by country, we can see essentially progress in all territories, save for the UK. And the UK struggled, of course, because of that slower first half. It has had impacts from volume-related contracts. These include volume-related contracts, and a slightly higher churn than usual at 1.2 million for the year. Other areas have all seen growth in ARR, which is a great achievement for us. If we look at then the HRA analysis, you can see here we started with 5 million. As a reminder, following the two difficult years that we experienced in 2018 and 19, we did a one-time exercise. So no new additions are going into this category. We do want to stop talking about HRAs, actually, to make the story much simpler for all investors. And ultimately, we want to be talking about this is a level of new business that was won. This is how we delivered. This is the profitability of the business. This is a single platform solution that we sold. And just talk about a very, very simple story. But obviously, necessarily with what happened through the last couple of years, we've had to bring out this granularity of performance measure. The risk of that 5 million was restricted predominantly into non-authored product rather than whole product portfolio, which is why there was only a ring-fence risk of 5 million. But as we've seen that progress over this year, 1.6 million we've converted to multi-year deals. So essentially have become normalized customers. We have seen customer churn, 1.8 million churned in the year. So we did lose that level of ARR in the year. And then a small adjustment for the estimate as that's come through into the year leaves us with 1.4 million to come through in the future. And you can see on the bottom right-hand corner which territories that risk lies in. We have budgeted for loss of 0.8 million of that in this particular year. So we still do expect to retain at least 0.6 million of that heightened risk accounts. And if we get to the end of this year and that's the position, then of course we'll remove that into business as usual, because at that level it's not sort of material to our performance, and we'll bring that into business as usual at that time. So good progress on the heightened risk accounts, just for your information. So then let's look at churn. And we can see here, so 7.3 million of churn in the previous year, FY19, reduced to 4.4 million this year. That's the 40% reduction in churn I was talking about. Of the 4.4, we have 1.8 million of the HRIs, leaving us with 2.6 of churn. And you can see where predominantly that sits, large in the United States and in the UK. And then on the left-hand side, you can see the level that we're expecting to come through the course of this next 12 months, which is much lower than that, even down to sort of just about £2 million of normalised churn. And that's why we believe that as we move forward, we have a reducing churn a situation, an opportunity to increase TCV, and as a proxy for ARR, increase new ARR. And that's why we start to see a much more confident view forward of our ability to take the group back to growth and back to how PROACTIS has historically performed, of course, if we look back prior to this last couple of years. So I think now we're going to move into the financial section. I'll hand over to Richard to go through that.
Good afternoon, everyone. So just a couple of slides from me. First of all, the financial highlights. As you can see there, I'll pick out some of the key ones. Revenue for the year reduced to £49.6 million from the £54.1 million in the previous year. That was predominantly due to the net churn of 4.7 million in the prior year, in addition to the COVID-related impacts in our volume-related contracts, which contributed lower revenue by about £1 million. Adjusted EBITDA was £11.8 million versus the £15.1 million in the prior year, again following the flow through of that net churn in the prior year, offset by some cost-saving elements. Basic EPS, which isn't on this slide, was 19.9 pence per share, basic loss EPS, versus a loss per share in the prior year of 27.9 pence. Obviously, that was impacted by the £14.8 million that we took as an impairment this year, versus an impairment of £27 million in the prior year. As Tim mentioned before, that was due to a couple of elements. The impairment, about just below a third of that was due to COVID impacts on the delay of the transformation in certain areas of the business. And the other element of that was due to how we now manage the business. In the previous year, the buy-side revenues from France and Germany, plus the global transaction Supplier paid product, were under one group of management. This year, we've separated those out under different management, and that's led to different cash-generating units. So we've had to calculate impairment differently at the year end. Again, as Tim referenced, TCV was £14.6 million versus the £11.3 million in the prior year, a record year for the business, and up 29%. Just another couple of points on this slide. First of all, on ARR, obviously we've talked quite a lot already about HRAs and the separation of different levels of ARR through the previous slides. This just shows the headline amounts, obviously impacted by churn, normalised churn, HRA churn, and the COVID-related volume element of that movement. And finally, on this slide, net debt. At the year end, it was £37.1 million versus the prior year end, which was £36.5 million. As we mentioned in our August trading update, the year-end number would have been more around £36 million had it not been for a specific AR item in part of the US business, plus the lower volume related in that specific same element of the US business. So this talks through the reported to adjusted analysis. First part of the slide takes us from the operating loss for the year of £18.4 million and adjusts for the net core expenditure, the non-core net expenditure, intangible impairment and amortization, and share-based payment charges to show the adjusted operating profit of 4 million versus 8.8 million in the prior year. Again, that net churn, which has lowered revenue flowing through the P&L. And the bottom of the slide, again, going from a net free cash flow of negative 1 million and adding back the cash elements paid out in the year on that non-core net expenditure to take to adjusted net free cash flow of 0.9 million versus last year 6.9 million, again, predominantly to do with the lower revenue. So I'll now hand back to Tim for the final couple of slides.
So a lot of Richard's presentation is around talking about adjusted to actual, and of course we do appreciate that this is difficult for investors, and this is not sort of our sort of philosophy, our culture. We try to be as open and transparent as we possibly can. The group has obviously been through some difficult times over the last couple of years, and we felt it necessary to describe the impact of those exceptional issues that have hit us. And of course, what we want to do is make this an extremely clean presentation and clean numbers where we're talking about progression and the income statement is real in that sense. So we look forward to being able to do that over the coming years as we see through our problems and resolve all of those issues and move forward. So hopefully you can be patient with us on that. So in summary then, we are delivering well against our strategy, and we think that transformation of our business back to a growth company is demonstrably on its way now, although clearly it's early stage in that demonstration. And unfortunately in a SaaS business, the income statement is the last place that you see the transformation happen. COVID-19 is slowing the rate of acceleration, that is clear. But let's just highlight a record year in new business performance. And hopefully from the TCV slide that I showed earlier, you can see that the opportunity is very much larger even than that if we can access that opportunity. We've seen, in terms of accessing it, we've seen those strategic new business wins in Germany and in France, and we're hopeful in the short term in the States if we decide to take the specific opportunities that we have there forward. We've seen churn reduce substantially, and there is further opportunity for it to move and improve further in this year and beyond. That's allowed us to report for the first time a return to growth in the underlying ARR. That's a crucial indicator of the turnaround in the business. We found early adopters for the bePayd platform, and we're contracting, not contracted, to move forward with those early adopters there and really establish how that product might work in the market. And of course, as a baseline, with the relatively high level of net debt that we have at the presently, we have reset the banking facilities for that level and for this business plan. So whilst it's a relatively high, it is now foundationally well set and well structured, and we're fully funded for the foreseeable future under this business plan. And so our outlook, we're a profitable SaaS-based software company that is starting to generate cash, and will start to generate cash as we execute on the business plan. And we're in an exciting growth market. So despite being cognizant of the broader environment, COVID-19 affecting things, the business model is really resilient. We've seen that through COVID-19 in the first 6 months of the impact of COVID-19 through our delivery of our pre-COVID earnings target. So we're resilient in these difficult times. We're growing in these difficult times. Our pipeline is strong, and teams are now well established. We're certainly in France, Germany, and the US now much more mature than we were 6 months ago, than we were 12 months ago, because those are the changes that we made at those times. So we're now relevant and now ready to hit those markets with our product. And we're seeing the first sales. So that's establishing the proposition. The bePayd pipeline is good and growing. The product is very relevant to its target market in these particular times, but generally, in any case. That's allowed us to maintain earnings guidance at pre-COVID levels for FY21. And as an aside, almost, we're continuing to look for further independence now on the board. It's necessary independence on the PLC board to challenge the executives in the way that we ought to be, to make sure that we are doing the right thing in the right way, etc., etc. So we feel that we have being able to create the foundation that positions us really, really well to accelerate our growth rate, manage our customers and reduce that churn, and start to deliver into the income statement the benefit of all of the hard work that's been gone on over the last 6, 12, 18 months as we've reconfigured the group around our new strategy.